Welcome to Telltales. Today is March 13th, and this is the 11th episode of 2024. Today we will discuss the fascinating parallels between investing in the energy and the biotech sectors. The conversation starts by analyzing the global oil supply and demand balance, highlighting Saudi Arabia's outsized influence due to its excess production capacity. This sets the stage for examining how geopolitical factors can trigger significant price swings in the oil markets. Shifting gears, we then scrutinize the U.S. natural gas market, noting the potential for well shut-ins in the Marcellus region later this year due to storage constraints. The discussion then pivots to comparing the business models and investment merits of biotech companies like Moderna, BioNTech, Vertex, and LNTH. Key factors influencing appeal include drug pipeline, R&D productivity, cash flows, and balance sheet strength. We draw parallels between investing in biotech and energy companies. A blockbuster drug platform is akin to having a large oil or gas reserve that can be tapped for years, but getting there requires early success and skillful capital allocation. Stay tuned as we navigate this fascinating cross-sector of the investment landscape.
Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week, we discuss topics ranging from geopolitics and macroeconomics to energy and technology. You can sign up for our newsletter at telltales.us. That's TELLTALES.us for additional data and content you can use to follow along. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I'm going to cover the last three exhibits pretty quickly because we've done so much on chips and software in prior Wednesdays. We're going to devote most of today to healthcare. So we're going to need Jason, but hopefully he'll be with us in a couple of minutes. On Exhibit C, I've got a new way of thinking about the price of oil. If you look at supply of oil, there's clearly 3 to 4 million barrels a day, too much supply capacity, mostly with Saudi Arabia, to meet demand. So the question is, what price of oil would cause supply to come down so that it was within demand? And I think the answer is quite a lot lower. Now, why isn't this happening? Well, no, it's a free market. It's happening because the government of Saudi Arabia, run by a 32-year-old, the Crown Prince, has made a conscious decision to hold 3 million barrels a day off the market. Could that decision change? Yep. Could it change on short notice? Yes. So when we'll have a quick review of, the oil and gas pages, the 4 pages where there are companies that in the energy business. I'll do a very quick review so we have plenty of time to spend on healthcare. I wouldn't sell any of them. If I wanted to add to one of them, I think I'd do it later because they will trade down if Saudi Arabia decided that Russia wasn't behaving or other members of OPEC, and they just wanted to make the point that they could produce the additional 3 million barrels. How much down would it be? This has happened before. I think at least $20 down. So if WTI is trading at 76 or 77, could you see it below 60? Yes, definitely could happen. Would it be sustainable? No. But the problem is that in order to curtail supply is an 18, 24-month proposition. So in all likelihood, the Crown Prince will, and the people close to him, will continue to hold the production off. But it is something to reckon with. There is some news that helps on the supply of oil in the last day or two. The Ukrainians have managed to put drones into 3 Russian refineries that are hundreds of miles from the Ukrainian border. And refineries, as you can imagine, are particularly vulnerable to drones and missiles and cause enormous amount of damage. What typically happens is you have to take units down, and they generally stay down for 60, 90, 120 days. So the Russians, in kind of involuntary way, are going to be producing less than their 10 million barrels a day of crude and products. One of the good things about the energy business, when there are problems like there were when Russia invaded Ukraine, generally results in higher prices. Moving to Exhibit B, which is gas pricing, fortunately, the production has kind of flattened out in the 102, 103 range. So it was kind of alarming when the production got up to 104, which is the estimate for 24 last November. But for whatever reason, whether it's fewer rigs, fewer frac crews, production is kind of behaving. If you look at the bottom, the storage change, in other words, the difference between demand and supply was impossibly high in 23. All these statistics, which I've checked, I think are reasonably accurate. The total surplus was 3 billion a day. 3 billion a day over 365 days is $1 trillion a year. The total amount of gas storage is only 3.8 trillion. So what will happen, and we're at least 500 Bs, 500 or 600 Bs ahead of last year. What will happen later this year is that at some point there'll be forced shut-ins, and it will happen in the Marcellus, I think, because some of the nodes in the Marcellus trade at big discounts in the shoulder months, like May, June, when, after winter demand, before summer demand, and then the shoulder months in September and October. So you could see some impossibly low gas prices, which will make headlines. You see gas prices received in the Marcellus under $1. And at some point, wells will be shut in. Think of the Marcellus as being kind of a supplement to our storage program. On Exhibit A, the Biden administration has come out with their budget, and it's a political document. And you can see here the deficit. These are from early last year, that we haven't gotten a reasonably good set of CBO numbers. So I just have to revise these. But we cannot just run $1.5 trillion deficit indefinitely. The interest bill now is more than what we spend for defense. And that's just not sustainable. But, this is an election year. The Biden administration has added $500 billion more spending than last year. Now, Congress will never go along with all this. Even the centrist Democrats won't go along. It shows how irresponsible our elected politicians can be when they're facing an election such as Biden versus Trump in November. To just quickly cover the energy companies, given the fact that we could have a downdraft in oil, given the fact that with storage buildup, you could have some kind of involuntary shut-ins or some very low prices in Marcellus. Going from back to front, the first page is page 12. That's the gas companies. They're all behaving pretty well. Antero, EQT, and Chesapeake are all really well organized companies. These numbers are based on $3 gas. The forward price for 24 is like $2.60 or $2.70, so it's within hailing distance of $3. They're able to keep their production flat or inclined a bit, spending about half of their EBITDA. That's pretty good performance. We go to page 11, the oil companies, EOG, Magnolia, Permian, and Diamondback. They're doing fine at $75 oil. Again, you see that same pattern. They're able to keep their production flat or inclined a little bit, spending with their capex a half of their EBIT. As I say, if there is a possibility out there of a downdraft in oil that would last for some number of months, I don't think you come out of these things. I think if you have some capital to invest and something like that happens, EOG, which is just a superbly run company trading, something in excess of $100, you might be able to buy some EOG at $80 or something, or Magnolia, which is a smaller company, but awfully well done, might be able to buy some Magnolia at $15. So I think it's a potential opportunity. I don't think it makes sense if you have a position and you have a profit in it to do anything other than hold on. Page 10 are the midstream companies. These companies won't be affected too much by commodity prices going up and down. They are pretty predictable cash flow companies. You can see the dividend yield down at the bottom of the page. They're in the 6, 7, 8% range. I have to say that they don't have that much capacity to increase their dividend because their debt levels are all fairly high. What has happened in this industry is they weren't sufficiently attentive to getting their money back quickly when they made investments. That's all changed. Every one of these companies from Kinder on down has changed their stance, and they'll do better in the future. Page 9, which is the integrated companies, Exxon, Chevron, Conoco. Well, Conoco is all production, Oxy's all production, and Cheniere is half of our LNG export capacity. These are really good companies. And once again, they can hold their production flat. They can, half their cash flow comes down to free cash flow. They're all trading for, around 10 times free cash flow. They're not bad investments to hold. Interestingly enough, your dividend yield on these companies is going to run in the 4% range. So it's about half of the midstream companies. But I do think that Exxon, Chevron, Conoco, they don't have the problem of handling their debt. They've all been able to use the extra cash flow to pay off all their debt. Just to turn back one page, if you go all the way back to EOG, you say compare EOG and Enterprise, both very good companies. Enterprise still has steady, 4 times free cash flow. EOG has paid off all its debt and has an extra $2 billion in cash. So all good companies, as I say, if you own them, don't be spooked, don't sell a position, but be aware, if we definitely have a downdraft in gas pricing, people will be alarmed to see Marcellus pricing under $1. But I've said this before, the cure for low prices is low prices. So, the lower prices are this year, the better 25 and 26 will look. And with that, I think there isn't a great deal of news on our page 1, Apple, Amazon, Alphabet, Microsoft, and Tesla. Just pause for a second, Mike or Jason, if there's any news in the last week that would affect any of these 5. Why don't we cover that, and then we'll get into healthcare.
Yeah, sounds good. As far as news on that front, I don't have anything that's really all that significant.
Yeah.
Nor do I. Yeah.
Yeah. And then I updated the NVIDIA numbers. I think Mike and Jason feel that NVIDIA is operating, this is page 3, on a run rate basis of free cash flow of around 40 billion. And this is 25 billion. The reason it's 25 billion, I gave the 10K. It's a January 10K. It's 1 month off, so it's 12 months to January. Gave it a careful read. These are the numbers out of the audit. And the difference between 25 billion of free cash flow and 40 billion of free cash flow is NVIDIA started to really amp up their revenue and their cash flow in the second quarter of last year. So you kind of have 3 quarters of their run rate rather than 4 quarters. Remember, I think it was 2 Wednesdays ago, we were discussing, and the question I asked Mike and Jason is, say in 3 years from now, let's say 26 or 27, will there be as much demand for GPUs from NVIDIA as there is now? Or will there be some kind of a cycle? And I said on a scale of 1 to 10, where 10 is optimistic, where are the two of you? And they kind of dueled over being 8 or 9. I don't think that's changed. So I was talking to someone this morning, and they said, oh, gee, at 25 billion free cash flow, this thing is 80 times free cash flow. I think at more optimistic assessments, it'll come down to 40 or 50 times free cash flow. Those are very high multiples. But if you own NVIDIA, it isn't necessarily, you can always sell half, then you can be only half wrong. But it certainly, I don't think, is a time to clear out of NVIDIA. And with that, make sure Mike and Jason are still at 8 or 9 on that scale of optimism.
Yeah, I maybe am more optimistic. The only I think the thing with AI is that there will be more demand for this stuff. Now, does NVIDIA maintain its market share and margin? That's probably the little bit of the risk. Do we have a recession that maybe slows some of this down? Maybe, but it seems like all the tailwinds are toward more, not less. So, Jason, I don't know if you have a different perspective.
No, I mean, technologically speaking, these models are moving from text into more computationally intensive tasks like video and audio. So again, more compute, not less.
I know both of you own ASML you own ASML and you're kind of fretting over whether that has gotten, whether it's pretty pricey. I have it here with $4 billion of free cash flow, which may be low, but it's trading at 100 times free cash flow. I think the other thing about ASML, it gets involved, and before we get into healthcare, maybe we just spend a couple of minutes on this, on how the tech industry handles China. ASML, which is based in Holland and does have a lot of operations in the U.S., both from their government and also from the U.S. government, is pretty limited in terms of shipping its equipment into China. But I think what is likely to happen, I mean, Mike and Jason are the experts, but it seems to me what's likely to happen by limiting shipments of that equipment, the lithography equipment, to Taiwan Semiconductor's ability to make this, that the Chinese entities can't get it. They're probably likely to figure out how to make it themselves. May take a year, may take 2 years, may take 3 years. But this idea that we can somehow slow down the advancement of technology in China by putting these export bans on is probably a little short-sighted. But once again, over to Mike and Jason for commentary on that.
Yeah, I totally agree. It's very short-sighted. The biggest risk of all of this is that not only does China develop their own technology, they develop a completely different set of technologies than what we're using. So, back when ASML went on the path for EUV, it took one of a couple different paths one could take towards producing these types of semiconductors. So there was a bunch of research that mostly died out because it didn't go out of from research into production, but could easily be picked back up. And I think we would be foolish to think that they aren't already going down some of those paths. And then they could just copy and do a fast follow on the ASML stuff. At this point, we've bred enough bad blood that they're not going to fret at all over stealing IP. So not that that was ever an issue before. So.
Right. Jason, on to healthcare. My two favorite names that they own are LNTH and Vertex Pharmaceutical, and we've covered those in the past. These companies are back on page 15. My sentimental favorite is BioNTech, because the Turkish couple that moved to Austria or Germany or wherever they are and started BioNTech seemed like really solid citizens. Of course, BioNTech was what enabled Pfizer to have a COVID vaccine, and they really piled up a lot of cash. I mean, they're really kind of virtuous. If you look at the cash pileup, Moderna has $8 billion of cash as of when I last did these numbers, and BioNTech had $16 billion. But the problem that Mike and Jason pointed out, that even though they have technology, and Jason gave us a briefing on RNA and what it is and what it does last week, they don't have cash flow. So they're kind of using their cash pile to finance the R&D budget. And as Mike and Jason explained last week, they're kind of committed to companies that are investing their R&D not only out of a good balance sheet, but also cash flow. And it turns out that Lantheus and Vertex Pharmaceutical are both in that position. So I view BioNTech as more virtuous than Moderna because they've hung on to more of their cash. Now, maybe Moderna comes up with breakthrough drugs and gets through regulation, and maybe 2 or 3 years from now, but Moderna looks better than BioNTech. But I think what Mike and Jason would say is both of those are impressive, and what they were able to do with the COVID vaccine is impressive. They were originally trying to develop cancer medicine, and that's what they're doing now. So that's to be applauded. But I think from an investment point of view, Mike and Jason have more confidence in companies like LNTH and Vertex Pharmaceutical, and some companies that they're working on that will eventually make it into the 20 pages, but they're still working on. And with that, an introduction, if we can all hear Jason, over to you, Jason. Mike and I view Jason as the expert in healthcare. So the possibility that he wasn't going to be on put a great deal of pressure on Mike and myself. Over to you, Jason.
Yeah, and but BioNTech's a whole different animal, and we've been wrestling with how to think about it. Like you said, we like to invest in companies that are financing research out of free cash flow, but BioNTech had a tremendous amount of free cash flow, and now it's gone away. But they have this huge cash store. So is their balance sheet strong enough to get them to market on some of their drugs? It probably is. I personally like BioNTech's pipeline better than Moderna's. They're both working on very similar things. I think Moderna is maybe over-indexed to producing vaccines, a lot with flu vaccine, that kind of thing. They're, in my opinion, looking at very competitive market for more common vaccines. Whereas BioNTech, their whole mission, the company was started to produce a cancer vaccine, and that kind of back to what they're focusing on now. Moderna split their interest. That's what they wanted to do originally. They're still pretty far along with a melanoma vaccine. But in my opinion, they're getting a little distracted with what worked from them in recent history of, viral vaccine. So of those two, I like BioNTech a little more. I believe in their pipeline a little more, and they're being a little more efficient with their research dollars.
Well, I'm happy to prefer BioNTech to Moderna, especially if Jason prefers it. That kind of reinforces my preference. But better to have cash flow like Vertex and Lantheus have, I guess you conclude.
Absolutely. Just to chime in there, if you look at Vertex, Vertex spends $3.1 billion in R&D. Moderna is doing $4 billion. So, Moderna is going to rip through some cash here pretty quickly, unless they have a hit pretty soon. That tells me that it should be cheaper to buy it later. BioNTech's a little more cash efficient. I think they've got quite a few partnerships with a number of their pipeline products. So, there's many ways to skin the financing cat, so to speak, in biotech. Maybe more creative than in energy, but at the end of the day, it's a similar problem, right? You have a drug that operates kind of like a well, and it runs out eventually. So you've got to replace that. So you got to use that cash flow to reinvest in, additional sources of revenue. And some companies are better at it than others. And I think that's the most challenging thing about this is, identifying the management teams that are consistently good at capital allocation. And, I think the corollary to oil and gas is oddly more similar than we would have guessed. And just like with oil and gas, you have to know all the ins and outs, the details of the oil fields and where their land is and how, the geoscience behind the rock and all that stuff. It's not actually that different when it comes to healthcare. So we're pleasantly happy from that perspective. But I think it's an industry that probably weighs more towards excess than at least the current state of the energy industry does.
Yeah, you could think of if you have a drug platform, that's a huge reserve that you can tap for years to come, and drilling new wells. Whereas if you have a one-hit wonder drug, that is going to be fast followed in the industry, you don't have all the reserves.
Right. One differentiator though is Vertex. I think Vertex has just done an amazing job of out innovating itself in one particular patient group or disease area. So sometimes that level of vertical focus is really important. But even Vertex has now kind of hit the point where they have to branch out into other disease areas. And, so those are some of the things we're most excited about. But that's the risk also, right, is stepping out into additional disease areas. Is it within their competence?
Well, in Vertex's case, with cystic fibrosis, now they've pushed the boundary so far on treating the disease, and finally now gene editing has come to the point where they can start investing in curing the disease.
And there is an energy corollary here. I was raising a question with Mike and Jason. What are the numbers say for people with cystic fibrosis?
With CF, global cases is around 100,000. In the U.S., it's about 30,000.
Right.
So it's a relatively small patient population.
But that is growing because they're so successful in treating those patients that they're living much longer, healthier lives.
Yeah, that's what's amazing is not long ago, the life expectancy for someone with CF was, what was it, Jason, like 30, late 30s, early 40s?
Yeah, it was in the 30s.
Today, it's like 72, which is about what the mean is in the U.S. population. So
it's remarkable.
Yeah, it's really a very cool. I mean, you think about a business that focuses on, think about Amazon. Amazon's whole thing is about customer success or customer, the customer is always right. If you just keep on innovating for your customer, that tends to pay out over the long run. So I really like that angle that Vertex has taken.
Hi, I'm Dawn with Oakcliff Sailing, and this is what happens when you hit one of our boats. So we have opportunities for you to train in match racing this year. You can start on Thursday night drills in the middle of May, where you can do practice. Then you can move on to grade 5s, and then all the way up to a grade 2 at the Oakcliff International. We have the team here putting the deck back onto a match 40, which is insane. The talent and the learning that's going on. 2 winter saplings on site, staff members, all graduates have worked their way up. Also, on the party side, we have the Water Lovers Mixer at the end of April, and April 6th is the art show and champagne brunch. You do want to be there. If you did not receive an email with this yesterday, please go to the website, go down to the bottom and sign on. If you have any problems, you can email me at race@oakcliffsailing.org. Have a great day.
One thing that I picked up over the weekend at Barron's or something was a commentary on gene editing, I guess is one way to phrase it. And they were comparing gene editing where you pull material out of your body and work on it, then reinsert it in your body, and have, quite a significant regimen you have to go through, as compared to gene editing, where you're actually doing it without pulling anything out of your body. Of course, an awful lot of that is happening on a research basis. I don't know that there are any medical treatments that have gotten regulatory approval to do it, in your body. But if you had to guess, I mean, this is a little bit like the 1 to 10, where 10's most optimistic. If you had to guess on progress in any of the companies that we follow, or just any companies achieving that kind of landmark treatment in 3, 4, 5 years on a scale of 1 to 10, how optimistic are you on someone being able to achieve that? Of course, you got to worry about side effects. I think it's probably just done now with fatally ill people, and they're the ones that, go into these trials. But Jason, where do you think the industry as a whole will progress in the next 5 years, would you think that there would be some medical treatments within 5 years, or how do you view it?
I think it's a pretty low probability. I think it will eventually happen, but within that time frame, very unlikely. The one step that you can't do when you're editing genes in the body versus culturing cells and editing them outside the body is then testing those cells for the type of, they call them off-target edit. So did the process introduce any other genetic errors while you were trying to change or delete the genes specifically that you were targeting? And the side effect there could be cancers or other impacts, right, that we were unaware of. So I think that running the clinical trials are going to be a very difficult process to do in vivo genetic editing. And they're probably going to be very time consuming because you'll want to see the rate that those patients develop cancers over the medium and longer term as well. So if you cure one condition, but then introduce other deadly conditions, that the benefit there is something you have to weigh. But I think running the trial to get there is going to be very complicated. And there are a couple of companies that are doing this, and they're in phase 1 testing. I believe all of them are still in phase 1, maybe 1, 2. So getting through that hurdle and then running a long, complicated phase 3 with an observation study after is going to be time consuming and expensive and difficult.
Right. Any commentary, Mike? It's about time for us to bring off and save everything for next Wednesday. Any commentary on Jason's comments?
Nope, I agree. Unfortunately, the reality is you have the potential of with an in vivo treatment of 1 step forward and 2 steps back, and that does not play well with our FDA approval process.
Right.
Good. Well, we're going to try over the next few Wednesdays to spend at least a significant chunk of our 30 minutes on healthcare. And in the meantime, everyone be well and stay healthy. And we'll be on again next Wednesday. Take care, everyone.